Good afternoon, everybody. Welcome to our first webinar in Nebraska Farm Bureau's Inside Profitability series. It's a new series that we're starting of webinars, podcasts, and social media that are focused around farm and ranch profitability. And thank you very much for joining us today. We sure appreciate it. My name is Jay Rempe. I'm Senior Economist at Nebraska Farm Bureau, and I'm hosting today's event. And today we're going to focus on Livestock Risk Protection Insurance, or LRP. Now, the series, the Inside Profitability series, is a series of events that we're going to focus on topics essential to producer profitability. And the topics, I think what will make it unique, with the topics are going to be identified that we try to tackle, will be identified by our members, and will be ones that we think are key to managing and maintaining an economically viable farm or ranch operation. So we certainly hope that the series will be informative for you and that provide you with some materials of value that will help you in managing your farm and ranch in these volatile times. So again, today's webinar is going to focus on LRP, and that topic was chosen at the behest of our Cattle Markets Task Force that met last year and made recommendations regarding the cattle markets. And one of the things they recommended is we do a webinar on livestock risk protection and other measures of risk protection that cattle producers can take. As everybody knows, the risk inherent in cattle production are growing every day. And just in the last couple of years, we've had a fire, pandemic, and then a couple of weeks ago, a cybersecurity attack that have rocked the cattle markets, and prices can swing wildly. And when those shocks occur, it's often too late for the producer to respond. So LRP, because it's designed to insure against declining market prices, can be a tool for producers to protect themselves. And changes to that product over the past year have made it more attractive for its use. So today we've gathered a panel of three experts and individuals that have experience with LRP that will share their insights with the program. Today we have Zach Hyland, who is a regional crop consultant with Farm Bureau Financial Services. He's first going to provide a background information on the program and how it works. And then we also have with us today two cattle producers, Rod Christian from Steiner, Nebraska in southeast Nebraska, and Robert Wareham from Whiting, Kansas, who both have experience with LRP, have used it on their operations, and they're going to talk a little bit about their experiences with it, the good, the bad, and the ugly. So after the presentations, we're going to open it up to questions, but you can ask a question at any time if you want using the chat function or the Q&A function. Just simply type it into either one of those, and then we will see it and we'll make sure it gets asked later in the program. Or once we get to the Q&A, you can raise your hand and we can unmute your mic and you can ask the question that way too. So a couple different ways to ask questions. So let's get started. And I'd like to introduce Zach Hyland with Farm Bureau Financial Services, the regional crop consultant. And he's going to talk a little bit about LRP and give us a little bit of background. So welcome, Zach. Thanks for joining us.
Well, thank you very much for having me today, Jay. I'm very excited to talk about livestock risk protection. And really, this is a product that we have seen a growing interest in over the past I would say 6 months, really since the start of 2021, livestock risk protection has really taken off nationwide. And one of the reasons for that are the changes to the program, which I'll get into. Before we talk about the changes, though, we'll just get into a little bit of the background on LRP. So first, we'll talk about the concept of the program, what it is, how it works. Next, we'll get into the different decisions that you as a cattle producer need to make when looking at purchasing this product. We'll talk about how the indemnity payment process works, and then we'll get into a few of the reasons on why choose LRP, and then just a couple of items to keep in mind if you decide this program's right for you. So conceptually, what LRP is that it provides protection against declining livestock prices if the price as specified in the policy drops below the selected coverage price. So essentially what that means is each day, RMA, the risk management agency of the federal government, takes the data from the Chicago Mercantile Exchange to set a price on the different categories of livestock. You as the farmer can then lock in a percentage of that price, anywhere between 70 and 100% of that price. And then when we get to the end of the insurance period, If the ending price is below what you locked in, that's when the claim is triggered. So again, it is 100% a price protection program. Causes of loss such as disease or death of cattle are not covered. But the most important piece of the price of those livestock is well protected through this. As I mentioned, with this program, sales are available on a daily basis, which is great. As we know, people are getting cattle in at different times of the year. Those cattle markets fluctuate quite a bit. So with those daily sales available, you're able to see a price out there on the market. And if you've got cattle to be insured, you can lock that in. So when a cattle producer is looking at purchasing this program, they really have four main choices. Number one is going to be the type of insurance. We'll get into what these different categories mean and what's involved with them in a minute here. But you're going to be looking at your type, whether it's feeder cattle, fed cattle, swine, lambs. You're going to pick your type, and then you'll pick your coverage price. So again, those are the prices that RMA establishes through Chicago Mercantile Exchange, and you're going to choose a percentage of that. Third is going to be the number of head that you're going to be insuring, and then the fourth is the length of your coverage. So those different types of insurance that are available. For fed cattle, there's really one class. So fed cattle or your fat cattle are going to be the ones marketed for slaughter. It can be steers or heifers that you expect to reach between 100 and 1,400 weight at time of slaughter. Second type, which seems like it's probably the most popular, especially in the state of Nebraska, is going to be your feeder cattle. So you've got multiple different classes here. You've got a class for steers, and then a subcategory for under 600 pounds or between 600 and 900 pounds. Same way with heifers. Dairy cattle can be insured through this program, as well as Brahmins. And then a change for 2021 was that unborn cattle can also be insured. So those cow-calf operations can insure those newly born or not yet born calves. We also have coverage available on swines and lamb. We'll not get into a whole lot of detail on those products, but the coverage works the same way as it does for the cattle. And I'd be happy to give you more information on those programs if that's a product you're specifically interested in. So our second choice on an LRP program is going to be your coverage price. Those coverage prices range between 70 and 100% of the daily livestock price established by RMA. Think about these coverage prices as deductibles. So if you elect a 95% coverage price, you essentially are going with the 5% deductible, meaning that the livestock market would have to decrease, or if the livestock market decreased by 5% or more, then the claim payment would start to kick in on this program. But again, we sell coverages all the way from the lowest level at 70 all the way up to the maximum at 100. It's really just a matter of determining what numbers you need locked in, how much coverage you need, and what your risk tolerance is on those cattle. The prices are established each day at 4 p.m. So with this product, it's important to work with an agent who is either, number one, technologically savvy enough to do things over the computer and get those prices and forms sent to you via email, or work with somebody local who you know is going to be working after hours, so you can get there between 4 p.m. On the day the prices are announced that you want to lock in, and 9 a.m. the next morning. As I mentioned earlier, when the actual ending value, so the price that RMA establishes at the end of the insurance period, is less than your coverage price, that's when the claim's triggered. With these coverage prices, as a crop insurance program, LRP is federally subsidized. And the level of subsidy does vary based on the coverage price that you choose. So if you're at the 70 to 79% level, that's subsidized at 55%. So the total premium, you'll only pay 45% of that number. At the higher coverage levels, it kind of scales down 90% to 95%. You're going to receive a 40% subsidy, and 95 to 100, you're going to receive a 35% subsidy. The third item when determining your LRP coverage is the number of head you're going to be insuring. So with our feeder cattle, you can insure up to 6,000 head per endorsement that you sign. So the endorsement is when you're locking in that coverage. You could insure up to 6,000 at one time and 12,000 throughout the entire crop year. The crop year for the LRP program spans from July 1st to June 30th of the following year. So we're talking about this at a good time because the crop year rollover happens tomorrow. In order for livestock to be insurable under the LRP plan, you have to have an ownership share of those cattle. So it must be owned by the person who is taking out the policy here. There's no requirement to insure all of your livestock in the LRP policy. A lot of folks, if they've got, let's say, 100 cattle that they're looking at insurance on, will only purchase coverage on 90, maybe 95 of them to account for maybe some potential death loss that may occur. But there's no requirement that you even insure to that level. A lot of folks we see, if they're still a little bit unsure about the program, will dip their toe in with maybe half of their insurable cattle, try it out, see how it works for them, and then depending on how they feel about the program, they'll insure the full total in the next endorsement that they sign up for. If you are insuring all of your livestock, though, and you do have death loss, you must notify your agent within 72 hours. Your coverage will continue, will just decrease your total head insured that you have. If you don't notify your agent, however, and you don't sell as many cattle as you had insured on the policy at the end of the insurance period, that is a cause to void the policy. So it's very important that if you are insuring all of your cattle and you sustain a loss, let your agent know just as soon as you can. One of the things that we consistently get questions about with the ownership share of this is that, how do I verify my ownership? It's pretty simple to do. So if it's ever requested that you provide the documents that prove you have ownership of those cattle, a bill of sale from prior owners will work for that. If you have any financing or credit documents for those livestock, those will work also. The third item, and this is really important for a lot of cow-calf people, is that we can also use written statements from third parties, such as a veterinarian who came out and did some vaccinations on those cattle. If you have a document saying that the veterinarian vaccinated 100 of your cattle, we can use that to establish your ownership of those 100 cattle. And then finally, when you sell the cattle, that bill of sale can work to verify the ownership share also. All right, our next choice for the LRP program is going to be the length of endorsement that you choose. So for our feeder cattle and our fed cattle, you can go anywhere from 13 up to 52 weeks. So the important thing to determine when you're choosing your length of endorsement is that you must keep those cattle up to 60 days from the end of your endorsement. So you can sell them. If you pick a 52-week endorsement, you could sell those cattle roughly eight to 9 weeks before the end of your insurance period and still have coverage. If you sell those cattle previously to that 60-day window that you have to sell them, then coverage is terminated. With feeder cattle, though, you do not have to sell them at the end of your insurance period to be eligible for a claim. If you'd like to hold them over to get them to the next weight class, if you'd like to totally feed them out for slaughter, you can do so, and that's still acceptable under the policy. And you can purchase a second endorsement on those cattle to cover that period that you're going to be holding them into the future. With with fed cattle, though, those do have to be slaughtered or sold before the claim can be paid. So that kind of gets us through our choices on this program and into how a claim scenario works. So for our claim example here, our farmer is going to sell 1,000 head of 800-pound steers on August 22nd for $118 per hundredweight. The CME expected value that they locked in for those cattle was $124.80. Now, with this program, we do have to remember, we're not looking at the number that you, the farmer, sold those cattle for. We're looking at the RMA numbers and those CME expected ending values and actual ending values to determine if there was a claim. So our expected ending value is $124.80. With the coverage level this insured chose, they had a guarantee of $122.82 per hundredweight. On the end date of this endorsement, which is 8/30, the Chicago Mercantile actual ending value was $115. So we can see that we've got a price loss here. We were locked in at $122.82, and we came in at $115. So in order to calculate this claim, we'll take the 1,000 head that were insured, multiply that by the pounds, so 800 weight, multiply that by the difference in price, which is $782. So that is going to give us a $62,560 deficiency between the expected value of those cattle and what the actual value was based on the CME prices. So that means once that claim is processed, a $62,560 check will go to the insured in this scenario. So, to kind of wrap things up a little bit, why should you choose LRP to insure your cattle, to have risk management on those? It is a very, very customizable program, but I think it's fairly simple and straightforward to understand. All you really have to do is choose those 4 items that we've talked about, and that's how you lock in your coverage. The only real thing that you have to keep an eye on with your agent is those prices in order to determine when you want to lock in that floor price. Another great thing about LRP is that it's available to all livestock producers of all sizes. If you've used market options in the past, put options can be very restrictive against smaller options. Some of the pricing of them can be a little costly. LRP is a great alternative if put options just aren't right for you, and can even be a better alternative sometimes too, because with LRP you're setting that floor price, and then the upside is all yours. The increased subsidy and insurable head do make this more attractive. In the past, we heard, it was too expensive, or producers couldn't get as coverage on as many cattle or hogs as they would like. Those limits have been increased to hopefully alleviate that concern. And then the last thing that's great about LRP is that claims are paid very efficiently once those ending values are calculated, and the claims process is automatic. So if we at Farm Bureau and Rain and Hail calculate that there is a probable loss there based on the numbers, we automatically send the paperwork to you. All you have to do is provide a couple of documents proving that you sold those cattle if they are fed cattle. If they're feeder cattle and you are choosing to hold them over, all you have to do is indicate that, sign off on the documents, and then we can get that claim paid to you very quickly. Those enhancements to the program that I talked about, again, you can insure up to 6,000 head per endorsement for cattle and 12,000 annually. They changed the requirement to own the insured livestock for the last 60 days. That previously was 30. So now with a 60-day window to sell that cattle, you've got a lot more flexibility to take advantage of good actual sales numbers in your local area. And then the final one, or the final two, if you are a cow-calf operation, you can insure your unborn cattle. And then subsidy has improved from what it was in the past. These enhancements have already in the 2021 year. So as you can see, this is a slide with just a simple graph of number of feeder cattle insured in Nebraska. You know, in 2012, we had some decent numbers, there's some fluctuations up and down here, but in 2021, this has really taken off. There's a lot of folks seeing the value in LRP, and they're choosing that to protect their risk on cattle now. The second kind of data slide that I have here shows that this program does pay out. So, you know, 2012, 2015, 2016, 2019, more money went out on LRP than came in. So this is working. And one of the things that I think is important to look at anytime you're looking at any sort of insurance, but especially crop insurance and livestock crop insurance, is that it's very, very important to set a consistent risk management strategy on this and stick with it over 3 to 5 years. As we can see on this slide, on a national basis, our loss ratios will be high 1 year, and then folks will jump into the program. And then with markets doing well, loss ratio goes down the next year and people exit the program. So what that, you know, by jumping in and jumping out of the LRP program, you're not protecting against those long-term unforeseen market declines. So I really see value in, if you are interested in this program, commit to it for 3 years, and keep a consistent risk management strategy. And I think it will pay dividends for you and protect your cash flows with this. So just a few final items to consider. Like I mentioned, July 1st is the start of our 2022 crop year. Now is a great time to have a conversation with either myself or your Farm Bureau financial services agent. What you can do right now is sign an application for this program and get access to daily price updates. There's no premium due, no coverage in place by signing an application. It just gets some of the initial paperwork out of the way. So when you see prices out on the market that you're ready to lock in, you can do that pretty efficiently. Again, there's 4 choices: your type of operation, which type of cattle you have, what weight they're going to be at the end value, the number of head you're going to be insuring, your targeted date of sale or slaughter of those cattle, and then the percent of price that you're going to be locking in. If myself or your agent can know those things previous to you buying coverage, we can also help look at the markets and see when those RMA numbers reach the level that you're looking to insure at, and we can get in contact with you to lock in some coverage. As I mentioned, sales are from 4 p.m. to 9 a.m. on a daily basis. So it is a little bit of an after hours program, but through technology and through local agents in a lot of small towns across Nebraska, we've got somebody who can take care of you and get you protected through this program. My final item to consider here is that you must have an 80-1026 filed at FSA to be eligible for subsidy. So the 80-1026 is your conservation compliance paperwork. If you're unsure if you've completed this, number one, I would say if you have a current crop insurance policy on either corn or soybeans, you're most likely in compliance with that. But by filling out an application, we can run that to see if you're in compliance. And if you're not, get you into compliance before you purchase coverage. So finally, my contact information is on the screen here. My name is Zach Highland. I'm the regional crop consultant for Farm Bureau. My phone and email are listed there. If you've got any further questions that aren't addressed through this webinar, or you're looking for somebody to work with to write LRP coverage, I'm more than happy to either refer you to somebody local to your area or work with you myself and get you protected with livestock risk protection. So thank you very much, and I will hand things back over to Jay.
Thank you, Zach. I hope everybody can hear me again. Thank you for that informative PowerPoint presentation on LRP. Now we're going to take a little different turn and have a couple producers that have used it or looked into it, talk a little bit about it from their perspective. And Rod, Christian, I think we'll start with you and let you talk a little bit about your experience with LRP.
Okay, yeah, that was a nice presentation there, Zach, that helped us kind of even refresh some of the changes anyway. So I'm Rod Kristen. I'm from Pawnee County, Johnson County area. We're livestock producers, landowners. Our family is primarily focused on cow calf feeder calves, but I mean, mostly we're just trying to market our grass as effectively as we can. We normally market our feeders, or used to anyway, in that November, December, or January, February, either side of the year, kind of depending on taxes. We market ours through local sale barns, but not all at once. So our marketing strategy isn't exactly consistent. The first time we considered holding our own feeder calves to grass them and market in the July, August, September area as part of our drought management plan. Feeder cattle were at that time at an all-time high. So we kind of jumped in for the first time and utilized LRP and felt that allowed us the market confidence to keep them to a heavier weight and sell them out there a little further, and then market them more at a heavier weight, running them on grass, which was new to us. So we participated in the LRP then, and by the time that we did market the cattle coming off of grass, the price had dropped and it had worked out really well, and we were glad we did it. Our main focus was to not only use it as a price protection on the cattle, but really more as a management tool for grasslands, as far as when we marketed our cattle and bring those cattle into a little bit different market period than we were for our drought management. Especially, at that time, the prices were high and it worked really well for us. That's kind of a background on what we do and how we utilize that. So that's kind of what I've got for now. Jay?
Yep. Thanks, Rod. Appreciate that. Yep. Appreciate the background and the little bit of information on how you use the program. Robert, we'll let you come on screen now and share your experience with the program as well, and then we'll open it up for questions.
Okay, thank you, sir. Last year was the first and only year that I gave LRP a try, and I have to say that I was motivated by concern, and it was mentioned earlier by Zach, I believe, but the volatility that we've seen, you can go clear back to the cow that stole Christmas and all the way up to the Holcomb fire and COVID. And there just seems to have been more and more volatility and things that can come about to wreck the cattle market. We're a cow-calf operation. We background them into January and keep a majority of our heifers and develop them. But it's kind of one big check every year on those feeder cattle that are born on our place. So last summer, I gave Casey Engel a call and looked into it. And at the time, I could lock in my mind, $1.40 for 750-pound feeder steers. It was $1.39,842 for basically $4.05. At the time, the board was $1.4441, and that just sounded like a pretty good deal to me. So we tried it on 100 head, and when January rolled around, the market had dropped to the point that the claim was based on, I forget what exactly, but it was a $5,895 claim. But of course, you had your premium. Remember, that cost was 4.5 cents a pound. That was $3,400. And you take that off, and I netted $2,469 or $24.69 a head, which was great. But more importantly, it gave me the peace of mind as we went through fall, an interesting election, to say the least. In the back of my mind, I knew my feeder cattle weren't going to sell for 95 cents in January because of something that went on somewhere else that I did not have any control over. As we go forward, I really see this being a good management tool. The risk you do run, and I think it was mentioned briefly by Zach, your cattle may not bring that price. And in our case, we sold in the middle of January, and they didn't bring $1.39.8, the big bunches of steers. So we was a couple cents off that, but more than the $24.69 a head, I really appreciated the peace of mind as we went out of summer through fall and getting into winter, knowing that the bottom wasn't going to fall out and wreck the one time a year that we sell all our feeder cattle. When you look at it today, I had Casey look at it the 28th. Feeder cattle in January are $1.62 on that day, and you could lock them in for about $5.35 a head. That's $1.56. That looks pretty good at $1,174 a pound. You kind of know you're going to get in that ballpark when you're going to bed every night from now till January. So the volatility, it's less cost than options, and certainly cost and risk associated with futures contracts. You got to buy 50,000 pounds at a time. I looked into that. The cost was considerably less, no doubt, because of the subsidy through the crop insurance program. And it just looks like an excellent management tool. It worked for us last year, and I foresee using it again, possibly on more head. I think that's all I got, unless there's questions here later.
Thank you very much, Robert. I appreciate that and how you used the program. And now we will open it up for questions from the audience, for anybody that wants to ask. Again, you can ask your questions either through the chat function or the Q&A function. Just type it in there and we'll pick up on it and make sure that we ask our presenters. Or if you have a specific question, you could raise your hand and we'll, our host, Phil, will unmute you. You can ask it directly. So we'll see here. Phil, I don't see any right now to get started. So I'll ask a couple questions of the group, and I'll start with our two cattle producers. Just curious, your words of advice, both Rod and Robert, to any producer that hasn't used the LRP yet. What are some things that as you got into the program that you thought or you think might be worth somebody knowing before they get into working through LRP and purchasing it and the like? Any words of advice that you might have?
Well, I would say, and Zach offered, but I would give him a call. He gave everybody his phone number. You do want to have somebody that's familiar with it when you sign up for it. That's why I gave Casey Engel a call. I think if you take just a little bit of time and really look at it, it's an excellent tool at a reduced cost. So my advice is just to take the time to look into it by having somebody let you know what they can do at what cost.
Rod, anything from your perspective? So yeah, one thing I didn't mention too, for us, I mean, we were very conservative and a little skeptical with it to start with. So we're a smaller operation and we didn't want to put all our eggs in one basket. So we, you can market, I'm pretty sure it's down to just one head at a time. Now we started out with 5 to 10 head at a time and felt, just to get familiar with it, see how it works. And we kind of just kept riding the market up and continuing to do some contracts. And the fact that we don't market all at one time, we were trying to tailor those to as close to when we thought we would market them. So we didn't miss that window to having this protection at the same time when we actually plan to sell the cattle. And we went through our local rain and hail agent and was already our insurance agent. We had the confidence that, we can meet after hours and get the signatures when we needed to do it. And we did it not exactly like they said we're probably supposed to stay in it long term. We jumped in when we felt the market couldn't possibly go any higher, that we felt, this was a win for us. And that was our first experience. And then when we've done it after that, sometimes, the insurance paid, and then sometimes the market swung up and we were happy to get the price increase on our cattle.
All right. Thank you very much, Rod. We do have a question that came in. This is a question for Zach. I work in crop insurance and we are waiting to venture off into the livestock side. How can I start my journey to sell LPR, LGM, and DRP?
Yeah, so I do have a little bit of experience on the crop insurance company side also from a previous role. So, I would reach out to whoever your marketing rep is with the company you're writing your crop insurance with, Lexi, and they'll be able to get you involved in the training required. There are 3 additional hours of training required for each of those programs you mentioned, LRP, LGM, and DRP. So you'll need to take those courses, and once you do, you can get your certification to do those programs. And also I've got to plug Farm Bureau a little bit here too. So, with my role at Farm Bureau, if you're a producer out there who's working with a current Farm Bureau agent who's not licensed to write these products, I can team with your current agent in order to get you coverage on some of these more niche products that maybe is outside of the typical corn, soybean, row crop policy. So if you've got somebody you're already working with at Farm Bureau, have them reach out to me and I can work with them also.
Thank you very much. Oh, go ahead, Robert.
Well, when I looked at it, the 100% made the most sense to me. I would like Zach's opinion, or maybe to hear percentage wise. I understand crop insurance on row crop too enough in that I insure it, and you generally don't insure to 100%. But what are most producers that have participated in LRP been doing? Are they paying up for the 100%, or are they going to a lower percentage?
It's all over the board. Recently, I've seen a lot of people going in, if not at 100%, 98, 96, somewhere in that range. But honestly, it is really about what your own costs are as a livestock producer. If you've got the cash flow where locking in at maybe 75% of that price, and you can get whatever that number is out there at 75%, protects your business that you have enough to where if you're only receiving that dollar total at the end of your insurance period, you're okay moving forward. You've got the cash flows to buy next year's cattle, then you're fine. But it's such an individual choice. Everybody's finances are different. Everybody's level of risk tolerance is different. But I would agree that the higher levels of coverage are becoming a lot more popular, especially with the subsidy increases.
Thank you.
Zach, I had a follow-up question I wanted to ask you too, just to make sure I understood it correctly. But in terms of the indemnity and how it's calculated, it's based on the ending value on the date or the ending date of the endorsement period. So if a producer sells their cattle, let's say 30 days prior, that sales price doesn't really matter in terms of calculating. It's the ending value on the day that the endorsement ends. Is that correct?
Yeah, you've got that, Jay. And that is kind of a unique concept to wrap your head around, that it's not the price that you're receiving at the local sale barn. It's the Chicago Mercantile prices when you lock in, and then on the ending date of your endorsement.
Mhm. Okay. All right. Any other questions from the audience that we might be able to answer?
If you're waiting on questions, I would have one for Zach.
Okay, go ahead, Rod.
Yeah, I was just going to jump in there too. It seemed to me, does the percentage of coverage fluctuate depending on the amount of participation in it? Because, for instance, it seemed to me like it wasn't always the same, whether it was 98, 99, 100%. Doesn't that percentage change a little bit as to how many people are participating in it, or is that not the case?
I understand the question, but I don't know if I have an answer to that. Yeah, that's something I could research, but I don't have that answer on the top of my head.
Okay.
Well, I think if you pick 100%, everything's set in stone. So right now, if you locked in on June 28th, or if the price was $162 or $1.62 per pound, that's locked in. If you lock it in, nothing will change that after you agree to do so. And you've agreed to pay $5.34.9 a pound for that protection 6 months down the road in January.
Yep, certainly. Yeah.
Once you have what your agent provides you, that's it. It's set in stone.
Certainly. Once you sign that paperwork and say, this is what I want and this is how long I want it for, that's locked in. That's not changing. But I think Rod's question was more in terms of the choices that you have in terms of coverage levels at that beginning. There are some slight fluctuations. One day it might be you can get 98.7% coverage, and then the next maybe it's 97.4 on that second level. And I don't know why that changes. I don't have that answer right now.
Okay. That was what my comment was about, because I had asked for my agent for, their printout, and sometimes, 100% isn't even an option. It might be that 97 or 98. And then we did run into once in a while, we needed to start ahead of time, or at least early on in the call, because phone lines were busy, and there was a little bit of a challenge on the other end to secure the contract when we wanted it. I don't know if that was just a timing then or not, but.
Yeah, so with Farm Bureau and with the rain and hail system that we partner with to do this, I've seen very little issue in terms of, not being able to lock something in. If those prices are published and we get it onto paperwork and we get it into the system by 9 a.m. that next morning, it's good to go. So I haven't seen that a whole lot. So you can be pretty confident if you're looking at a number available to lock in, you can get it as long as paperwork's done.
All right, thanks, Zach. I don't see any more questions from our audience. So unless our panelists, if you have any last words of wisdom that you want to share with the audience, I'd open it up right now real quick for you to do that if you have any more you want to add.
I would just encourage producers to give it a look. It was a large producer out around Salina, Kansas, that encouraged me to give it a look. That was a couple of years ago, and it was last year before I did, but it's definitely something worth educating yourself about.
All right. Thanks, Robert. Zach
So
or Rod, any?
My little bit on it was, on the other side of that scale, it wasn't from, we're smaller operations, and this catered to us as well. And it just give you a little bit of an idea how it works. And we didn't even insure all of our cattle. We just dabbled in it a little bit to start with, but it did certainly help get you familiar with it, see how it works, and it's insurance. So I guess bottom line, we hope we don't need it, but it was, like we've heard the comments here before, I mean, it kind of just helped you sleep at night knowing protecting you from something major swing in the market.
Thank you, Rod. Zach, anything from your perspective?
Yeah, I would just say if you've even got a spark of interest in this program, now's the time to sit down with your Farm Bureau agent, or call me in to work on that. And let's figure out how this could work for your individual farming operation. Everybody's so different. Everybody's got different risk management needs. We're talking in very general terms today, but by sitting down with your agent, we can get some specific numbers and how specifically this can work for you, and see if it's right for you.
All right. Thank you very much, Zach. Appreciate that. And I think we've got a new theme I've heard today. If you want to sleep better at night, look into LRP. So maybe a marketing campaign there. But I want to special thank Zach, Rod, and Robert for joining us today, taking time out of their busy schedules to share with us some information on LRP. I found it to be very informative, and I hope our audience did as well, too. For those that are participating today, you will receive a follow-up email with Zach's presentation on it and some links to some other sources that you could look into for the LRP. And I'd certainly encourage you to reach out to Zach if you have further questions, or any of our contact me as well, and we can get you in touch with the right people. The email will also include a brief survey on today's program, and we certainly hope that you would take the time. It's just 3 or 4 questions to fill out that survey so we can see what you thought of today's program. And then it also will give you the opportunity to suggest further topics for future events. And I might also add that this is being recorded and will be up on our website, and we're going to shape it in the form of a podcast too that people can have access to as well. So please take a look at that. And finally, if you're so inclined, our next webinar is scheduled for August 26th. It will focus on ecosystem or carbon credit tradings. We're going to try to get an economist from American Farm Bureau, who's done a lot of research into the area and kind of knows a lot of some of the things that producers are looking at in the way of carbon credit trading. And then we're going to try to get a couple of producers again that have looked into that to talk a little bit about it. So look for more information on August 26th. And carbon credit trading will be our next event. So thank you, everybody, for joining us. We hope you found this informative, and we look forward to seeing you again in the future on one of these. Take care.